Hi traders, in today's video we'll be taking a look at our thoughts on the current price of the S&P 500 index, as well as an important lesson that everyone needs to learn when it comes to investing in pretty much anything. Stay tuned. I'd just like to start this video by thanking everybody for the amazing support they've given this channel over the past couple of weeks. And I'd like to remind everybody to like if you enjoyed the video, comment down below if you have any questions, and of course, subscribe and hit that alarm bell if you want to receive more daily content on the current happenings of the financial markets. To start with, I'd like to take a look at the S&P 500 and talk about our thoughts on this current market and the conditions that have been happening to get this market to where it is. Whenever you're looking at technical analysis on any chart, the best thing to do that I've found over the years is actually to start on the largest time frame and to recognize where the market has been over a period. Now, this doesn't matter if you're a 1 hour trader, a 4 hour trader, or a daily trader. Everything about trading is being as informed as you can be about the charts and about what things have happened. So here we have the monthly S&P 500. If I was looking for key support resistance levels in terms of longer term, I would always start with this. I would put certain support resistance levels on my charts that are at key points, and I would actually probably label them in a certain color that I know is monthly support resistance, and I'd leave them there. And this means that when I come back in the future, if I ever see price around that point and I wasn't on the higher time frames, I would see it. So the monthly, we've talked about this one on the channel quite a few times and where we think potential could be over the longer term. What's interesting about the Friday close in terms of last week was that we got a shooting star candle, and that's been followed up by a gap open in the futures today. Gap opens usually fill, sometimes they don't, but we have seen pretty light volume because, of course, Japanese market is closed today, and really it's going to be up to the US to set a direction for what's going to happen to this index. The 20 and the 50 EMAs remain crossed on the weekly, and you can see the Fibonacci is showing that the market pulled back to the golden ratio, or 61.8, and that was pushing above 2,900 and just shy of 3,000. The importance of 3,000 is clear. It's obviously a huge psychological level, but it's also that kind of trap that often happens in the market. Many people don't think about the market as hitting psychological levels, but many people set take profits at round numbers. So whenever you're looking at a share and that share has never hit, let's say, $100 before, it usually stops shy just of $100, hits like a $99.50, $99.80 kind of figure, and then it will sell off. And that's there to spook people. And basically it makes it so that people think, oh, I missed the $100. They sell at a lower price. And then of course the share eventually does go back up and probably over 100 and breaks that level. It's all about that psychology when it comes to market trading. So the Fibonacci is very clear. It's hit the golden ratio. It's bounced downwards off it. And now we're sitting at around this 28.10 in terms of pre-market open. Once I've had a look at the weekly, I'll bring the chart down to a daily and I'll further analyze it. So let's get rid of this Fibonacci because we're very well aware of what's happened there, and talk about the daily. So now let's think, what is the daily telling us? Well, the daily has closed through the support. The 2,900 definitely did not hold, and it's now moved down and it's found dynamic support on these two moving averages on the daily, the 20 and the 50. If it continues to go down and it moves past this 27.20, that's when many traders will get involved in this market, because what they will be seeing is a break of a key support line. Whenever I'm looking at a chart and I think, okay, where are we with the daily? Have we got any clear signs? We often think, what about the smaller timeframes as well? What kind of pattern or potential price action are we seeing there? So it's about breaking down the charts. We know the weekly shooting star is there, but we also know that we want that little bit of further confirmation, because at the end of the day, the Fed is propping this market. Everybody is aware of that. Everybody knows that the Fed can make a decision. And when you're shorting a market where the Fed is artificially holding it up, you do need to be careful. So let's now have a look at the 4 hour and get our thoughts. Well, the 4 hour definitely presents a little bit more of an interesting case. And that is that while the market has obviously been selling off, pre-open or into open may actually remain bullish. Generally with the market, what you expect it to do is after a sell-off, it will pull back to a degree. So it would make sense that it potentially pulls back to the 2050 and then maybe continues to move down. Again, our thoughts are that we would want to see a lower low formed below this 2720 before we would be interested in shorting this market. And that comes back down to the idea that the Fed is controlling this market at this stage. Another thing I like to do whenever I'm looking at the market is to potentially draw a Fibonacci level when I do see dynamic support or dynamic resistance. So we'll do that now and we'll see what happens. Pretty much spot on to what I thought. So there's a 38.2 fib right around this level. And again, that's going to act as resistance. So you've got moving average dynamic resistance plus a Fibonacci. That's the kind of thing that I'd be looking at if I was a smaller time frame trader. We've recognized the shooting star on the weekly. We've bought it down. We know where our daily confirmation is going to be in terms of we're excited about the bear side, but we're also optimistically cautious because of the Fed. So from a technical analysis standpoint, what we expect to see is this type of thing. In terms of what happens, the Fed can change everything, and that's why you have to be cautious in a market like this. But that's the kind of price action analysis we generally do. And we'll be doing more of this on the channel as we move forward with daily videos. Now let's talk about what I think is more interesting from an investment standpoint. And it's a lesson to be learned whenever you are investing. And believe me, I've been burnt by this kind of scenario before. When we're talking about risk versus reward, everybody knows that if you risk $100 and your reward is $200, then of course that's a pretty good trade, especially if it's going to happen with a high probability. What we have here is the SPY, and we can see volume. And volume is kind of a key indicator to a degree of the type of investors that are in the market. Now, volume will always spike. Of course, in a bear market. As we saw here, volume was incredibly large through this sell-off. And then on the movement up, volume has decreased significantly. However, it is still well above where the market was in the previous pretty much year to year and a half. And that's because people were struggling to find investment value in the overall index in the last couple of years. It was doing well. It was at the end, or some would call it the end of a standard bull cycle. And now we have seen an amazing amount of volatility and therefore higher transactions come into the market. But what does worry me is that we have returned to halfway, and if you did an average of all the volumes across the board, it is on thinner volume. That can mean bigger traders are not involved in the market, and it does beg to question what is happening and what will happen. So then we want to bring across, well, what is everybody else thinking about the market, or at least what they're telling us anyway. So I'm going to bring up Goldman. A lot of people don't like Goldman. A lot of people do. It's fair to say both ways. That's fine. But they obviously see now risk to the downside is greater. And this is an old article. I admit this is obviously from April the 11th. But what I find interesting about this is the bit I'm about to highlight. And that is that they still remain with a 10% target year of 3,000. Now, I'm not saying they're right, but whenever you're looking at an investment, let's say you got 12 analyst ratings. And those analyst ratings for the index were 3,000. When you're looking at an analyst rating, you say, okay, well, maybe that one's wrong, that one's wrong, that one's wrong. But if they're all aggregated together and all saying 3,000, they do get paid a lot of money to come up with certain numbers. If you're trading a market that we are in right now with all sorts of problems in it that are clear to see, if you're trading it at 2,900 or even 2,850, what is your upside versus downside potential? So your upside might be, let's say, back to close to the highs. So this is your upside. The problem is your downside is so much more. So your downside can go all the way to new lows and even further, because we know that generally speaking, recessions or bear markets last around 12 to 18 months. So why would you invest at a period like this? Well, if you're investing for 10 years, 20 years, of course, you'll be correct, just like Warren Buffett is generally. And he says, of course, don't bet against America. It's always been the thing that he says. He's very happy with, of course, what the Fed's doing. I'm sure many people will say that the Fed has more tools in its arsenal, and it probably does. But at the same time, it's about thinking, what is my upside potential for this investment over the next 12 to 18 months because you want to make your money work for you versus the downside potential. And I think that's a kind of scary thing when looking at long-term investment in the SPY or in the S&P 500 right now. Another thing I want to bring up in this video is that so many investors, especially really rich guys, have a ton of money on the side ready to reinvest. Now, this is not uncommon. Of course, when you're really, really rich, it's usual to have a decent amount of money to take advantage of opportunity. But this recent article on April 30th, it shows investors and business owners are largely optimistic about the global's long-term trajectory, but 60% are waiting for a second stock market dip before buying more shares, the UBS poll published on Wednesday revealed. And I think this really presents what does everyone want? And more importantly, what do the big guys with the huge amount of money want? Now, of course, they don't want to see the entire economy collapse, but is even the stimulus that's been pumped into the economy, and remember, it's not all in there now, is that going to be enough to prop this market over the long term? So what I'd like to, pose a question to everybody today is, are you still buying America at this stage? Leave your comments down below, and if you like this video, please remember to give it a thumbs up and subscribe, and of course hit the alerts for more daily content we'll be bringing you. Thanks very much, everybody. See you in the next video.